The week ending April 11th, 2025. Buckle up, because it really felt like we were strapped into some kind of financial roller coaster.
Yeah, yeah. Global markets were, well, yank this way and that.
And the main conductor of this whole wild ride, the ongoing trade war, clearly. But there was, so much more happening beneath the surface than just those tariff headlines.
That's absolutely right. It was a week where news flashes had an almost instantaneous impact. You saw that immediate jump, that optimism, when the U.S. announced a 90-day timeout on some tariffs.
Right.
But then, well, the renewed escalation with China quickly reminded everyone that this isn't over, pulled back some of those initial gains pretty fast. It just really shows you how sensitive the markets are to any whisper, any hint of trade friction right now.
Okay, let's dive straight into the U.S. markets then. Because on the face of it, the week looked pretty good, didn't it?
Yeah, superficially.
The S&P 500 clocked a 5.7% gain, NASDAQ shot up 7.3%, and the Dow added 5.5%. You'd almost think it was party time on Wall Street.
You absolutely would, but it's so vital to put that in perspective. That strong weekly showing, it was largely thanks to that sharp rebound midweek right after the temporary tariff relief.
Okay.
And even with those gains, let's not forget, the major indexes are still significantly in the red for the year. So that burst of enthusiasm didn't exactly erase the bigger picture concerns. Not by a long shot.
And those concerns seem pretty well-founded when you look at the details. I mean, the U.S. didn't exactly extend an olive branch to everyone, did they?
No, not at all.
We saw tariffs on Chinese goods actually increase, jumping to, what, a hefty 145%?
That's a really significant hike, yeah. And maybe unsurprisingly, China didn't just stand by.
No.
They responded pretty quickly with their own tariff increases, pushing them up to 125%.
Wow.
And this back and forth, this sort of tit-for-tat is precisely what fuels this market volatility we're seeing.
Right.
One moment, there's, a glimmer of hope for things cooling down, maybe talks progressing. And the next, boom, we're back in the thick of trade tensions, and the markets just react instantly.
It really makes you wonder about the underlying strategies here. Yeah. Feels like trying to navigate a maze where the walls just keep shifting constantly.
There's definitely a complex strategic game being played out, absolutely. And it introduces a lot of uncertainty. Adding to this complexity, we also got a glimpse into the Federal Reserve's thinking. The minutes from their March meeting were released.
Ah, yes, the Fed minutes. What was the main takeaway there?
Well, what really stood out was the sense that policymakers are wrestling with a very delicate balance. They've got increasing worries about economic growth on one side, while still facing, stubbornly persistent inflation on the other.
So they're trying to keep the economy growing, or at least not stall it, without letting inflation run wild. That sounds like a tough balancing act.
It's incredibly tough. And that's precisely why their stated preference for a cautious approach to future interest rate decisions is so noteworthy.
Cautious approach, meaning?
Meaning they're signaling they're acutely aware of the risks on both sides of that equation, slow down too much, or let inflation get away. They don't want to tip it either way.
Then we have the inflation numbers themselves. The March CPI, Consumer Price Index, came in at 2.4% year over year. That's the lowest we've seen since early 2021.
Right.
That would typically be seen as a positive step, wouldn't it? Good news in the inflation fight.
It would, yeah, on the surface. That moderation, that cooling, could potentially give the Fed a bit more flexibility, maybe some breathing room.
That's always a but.
Hey, well, here's where it gets really interesting, or maybe concerning. We also saw a significant drop in consumer sentiment. It actually hit its lowest point in nearly 3 years.
Okay, wait. That doesn't quite add up. Inflation is easing, the rate of price increase is slowing, yet people are feeling more pessimistic. What's the disconnect there?
It's fascinating, isn't it? What seems to be happening here is that while the overall inflation rate cooled, consumers' expectations for future inflation actually jumped, rose to 6.7%.
6.7%. That sounds high.
It is. That's a level we haven't seen since 1981.
Yeah.
So even if current price increases are slowing down right now, the fear, the expectation that prices will be much higher down the line, that seems to be weighing really heavily on consumer confidence.
And that confidence, or lack of it, can have a real impact on spending, right, on the actual economy.
Absolutely. Affects purchasing decisions, investment, everything.
So that headline jump we saw in the U.S. markets, that 5-7% gain, might not really tell the whole story then.
Not at all.
These underlying anxieties about trade, about what inflation will do next, they seem to be casting a pretty long shadow.
That's a very insightful way to put it, yeah. The volatility we experienced this past week, Well, it's likely to continue as these different forces, the push and pull of trade talks, these ongoing inflation concerns, and the Fed's cautious stance continue to play out.
Okay, let's shift focus across the Atlantic. Over to the Eurozone, things looked decidedly less upbeat, didn't they? No big celebrations on the stock market front there.
No, quite the contrary, actually. European stocks generally saw declines last week. The Euro Stoxx 600 was down 1.9%.
Huh?
Germany's DAX fell 1.3%, and France's CAC 40 dropped 2.3%. That brief wave of optimism that lifted U.S. markets midweek, it didn't really gain much traction over there.
And the reasons for this downturn seem to be, well, a combination, right? Those same global trade tensions we can talk about, but also some concerning economic signals coming from within Europe itself.
Precisely. We saw weak industrial production data coming out of both Germany and Italy. That really dampened market sentiment quite a bit.
Germany and Italy. Those are major manufacturing hubs.
They are. They're the engines of European manufacturing, really. So a contraction there raises broader questions about the overall health of the Eurozone economy and how it's being affected by these global trade headwinds.
And it wasn't just looking back at past performance, was it? Italy also significantly revised its expectations for economic growth this year downwards.
Yes, that was quite stark. The Italian Treasury almost cut its 2024 GDP growth forecast in half, from 1.2% down to just 0.6%.
Wow, half. That's a substantial revision.
Yeah.
Suggests growing concern about the near-term outlook for one of the Eurozone's largest economies.
It certainly does. So it really feels like Europe is in a tough spot. Kind of caught between the fallout from these global trade disputes and its own internal economic vulnerabilities.
Yes, squeezed from both sides.
Exactly. And that combination, it naturally leads to a more cautious approach from investors, low risk appetite, and that's reflected pretty clearly in the market declines we saw.
We also saw central banks getting more watchful.
Yes, increased vigilance from both the European Central Bank, the ECB, and Bank of England. They're monitoring market conditions very closely. In fact, the Bank of England even took the pretty unusual step of postponing some of its gilt auctions.
Gilt auctions.
Yeah.
That's where the UK government sells its bonds, right?
Yeah.
Delaying those sounds like a significant move. Suggests some real concern about market stability, maybe liquidity.
It does, absolutely. It really highlights the level of uncertainty and the potential for further instability that central banks are currently having to navigate. They're clearly worried about smooth market functioning.
Okay, interesting. Now, turning our attention specifically to the UK, they actually had some surprisingly positive news on the economic growth front, didn't they? Despite everything else.
They did, yeah. Sort of defying the overall negative trend we saw in European markets. The UK reported surprisingly strong GDP growth for February.
That's strong.
0.5% month over month and 1.4% year over year. That's definitely a welcome bit of good news, and it was largely driven by strong performance in the services sector.
Okay, so some good news for the UK economy, a bright spot. But the stock market, the FTSE 100, still saw a slight dip overall for the week, about 1.1%.
Yeah.
Why the disconnect there? Good growth, but falling stocks.
Well, it really highlights the difference sometimes between what's happening in the, quote, real economy and how the financial markets are interpreting the overall picture, including risks. So, despite that positive GDP data, the Bank of England maintained a rather cautious stance, very similar, actually, to what we heard from the Fed.
How so?
They specifically mention ongoing concerns about market liquidity, echoing that auction delay, and also persistent inflation risks.
So even with better-than-expected growth figures coming in, the central bank is still sounding a strong note of caution. Still worried.
Precisely. And, mirroring that delay in the gilt auctions we just talked about, the Bank of England also paused some of its own bond auctions and issued warnings. Warnings about potential further market corrections linked directly to the instability in global trade. So yeah, while the strong growth figures are certainly encouraging on one level, the central bank's cautious outlook suggests there are still underlying fragilities or perceived fragilities in the financial system.
Okay, let's move east now to Japan. They were included in that temporary U.S. tariff pause, were they? And it seems their market responded accordingly.
That's right. Japanese equities saw a bit of a downturn. The Nikkei 225 index was down about 0.6% for the week.
And the reason?
Well, the fact that Japan remains subject to that 25% U.S. tariff on auto exports was definitely a headwind for their market. Cars are a huge export sector for them.
Makes sense.
However, towards the very end of the week, there was a little bit of optimism sparked by hopes for potential bilateral trade talks, just between the U.S. and Japan. That offered some late support.
We also saw a notable strengthening of the Japanese yen in the currency markets. quite a move there.
We did, yes. As investors looked for safer places to put their money amidst all the global uncertainty and trade jitters.
A flight to safety.
Exactly, a classic safe haven flow. The Japanese yen experienced a rally, reaching around JPY 142 against the US dollar.
And Japanese authorities usually don't like such rapid moves, do they?
Typically not, no. This kind of rapid appreciation of the yen is something that generally worries Japanese officials because it can make their exports more expensive and less competitive globally. They expressed some concern.
And the Bank of Japan, the BOJ, they're in a somewhat unique position globally right now, aren't they? Still talking about tightening policy eventually.
They are. It's quite different from many other major central banks. Governor Ueda reiterated the Bank of Japan's commitment, or readiness at least, to move towards tighter monetary policy.
Even with all this global uncertainty.
Yes, acknowledging the increased global uncertainty, but still signaling their underlying intention to, normalize policy away from those ultra-low rates.
Interesting.
So, yeah, while the trade concerns are clearly weighing on risk assets like stocks in Japan, their own domestic policy direction, that potential normalization, remains a very important factor to watch going forward.
Okay, finally, let's turn our attention to China. They were right in the crosshairs of those increased U.S. tariffs, and their market certainly reflected that impact.
Absolutely. Chinese equities took a significant hit last week. The Shanghai Composite Index was down 3.1%.
And Hong Kong.
The Hang Seng in Hong Kong saw an even more substantial drop, down 8.4%.
Ouch.
Yeah.
And the response from China?
Well, the sharp hike in U.S. tariffs triggered a strong verbal reaction from China's Ministry of Commerce. And they followed through by also raising their tariffs on U.S. goods up to that 125% level we mentioned.
But we also heard some indications that maybe China felt further retaliation might not be the most effective economic path forward.
That seems to be their current thinking, yes. Sort of acknowledging the limitations, perhaps the diminishing returns of simply escalating the tariff war further and further.
Okay.
But what's really interesting to note here, and potentially more impactful, is that reports emerged suggesting high-level discussions within the Chinese government about potential new fiscal stimulus measures.
Stimulus talk. And that news appeared to have a pretty quick impact on their markets towards the end of the week, didn't it?
It really did. The prospect, even just the rumor, of a significant new stimulus package sparked a 4-day rally in Chinese markets. It just highlights how sensitive investor sentiment is right now to the possibility of government intervention and support.
So how bad could these tariffs be for China's economy? Are there estimates?
Well, economists are starting to put out numbers. They're estimating that these latest tariff increases could potentially shave off somewhere between, say, 1 and 2 percentage points from China's GDP growth in 2025.
That's quite a hit.
It is significant. However, there's also a general expectation, a belief really, that Beijing has the financial resources, the fiscal tools, to offset a considerable portion of that impact if they choose to deploy stimulus measures.
Right. So while the trade tensions are clearly a major challenge for China, the potential for a large-scale stimulus package could actually become the more dominant factor shaping market sentiment there in the near future.
Yeah.
Maybe overshadowing the tariff news itself.
That's a crucial point, I think. The market's focus might well shift, or maybe it already is shifting, from the direct consequences of the tariffs themselves to the potential countermeasures, the stimulus being considered by the Chinese government.
Okay, fascinating. So, looking ahead to this week, starting April 14th, 2025, we have another pretty full slate of economic data and events coming our way.
Yes, plenty to watch.
In the U.S., we'll be watching Treasury auctions at the start of the week, Monday, Tuesday. Then Wednesday looks busy. Retail sales, industrial production, capacity utilization, business inventories, all out on Wednesday.
Right.
Thursday brings the usual weekly unemployment claims, along with updates on housing starts and the housing market index. And then, important note, markets in the U.S. will be closed on Friday for the Good Friday holiday.
Got it. And over in the Eurozone, the main event will undoubtedly be the European Central Bank's interest rate decision on Thursday.
What's expected there?
Well, the market consensus seems to be pointing towards a cut. Probably a 25 basis point cut to their deposit rate, bringing it down to 2.25%, as they continue to grapple with those concerns about growth that we discussed earlier.
Okay. And the U.K.?
The U.K. will also be releasing its latest retail sales figures on Thursday.
Japan.
Over in Japan, we'll get their final figures for industrial production and capacity utilization for February on Monday, followed by an auction of 20-year Japanese government bonds, JGBs, on Tuesday.
And China. Big one coming up there too, right?
Yes, indeed. For China, all eyes will really be on their Q1 GDP growth rate. That's due out on Tuesday. The expectation is for a slight slowdown, maybe to around 5.1% year-over-year growth.
5.1%. Still strong by global standards, but a slowdown nonetheless.
Exactly. So yeah, a busy week ahead with plenty of data points that could give us further insights into the direction of global economic growth, those ongoing inflation pressures, and, crucially, how central banks are likely to respond to it all.
Well, that was certainly a week packed with action, and it definitely sets the stage for what looks like an equally eventful week to come. The dominant themes, they were clearly the significant impact of trade war development,
Absolutely central.
the really mixed bag of economic data we saw across different parts of the world, and the varied approaches, the different concerns of the central banks trying to navigate it all.
Yeah. And it's really striking how quickly market sentiment can pivot based on just a few trade-related headlines, up one day, down the next.
And now we have this added dynamic, this potential wild card of large-scale stimulus possibly coming out of China to consider as well.
Absolutely. The contrasting ways in which markets reacted to the tariff news, the relief rally versus the renewed fears, coupled with the emergence of these new potential market drivers like the stimulus talk,
Yeah.
it truly highlights the complex and really interconnected nature of the global economy right now.
So here's maybe a final thought for our listeners to consider as we wrap up. Given these persistent trade tensions, which don't seem to be going away, and the really diverse economic signals we're observing everywhere, what specific future developments do you think will ultimately exert the most influence on global markets in the weeks and months ahead? It certainly feels like we're navigating a period of pretty significant change and uncertainty.